Hello and welcome to the Piranha Profits professional trading course, and welcome to the world of professional trading. I'm Adam Khoo and I'll be your coach on your journey to building a profitable trading business. So I believe you're listening to this because you realize that learning how to trade is really the only skill that can guarantee you an income for the rest of your life. Because nowadays, if you learn a skill like engineering or accountancy or programming, sure, that's a skill. But that skill can't guarantee us a job in 5 to 10 years. Because when we work for someone else with those skills, eventually when we get senior enough, we get too expensive to be kept, right? Our salary is too high, and we can be replaced by someone younger, cheaper, and faster, and even in the future, artificial intelligence. But when you can trade the financial markets anywhere in the world, as long as you've got a laptop, an internet connection, you're in business for yourself. You have an avenue to create income for the rest of your life, and that's true freedom and security. So with that, let's get started to learn about the business of professional trading. So how do you make money in the trading business? Well, trading is like any other business. In any business, you make money by buying low and selling high, or selling high and then buying low. For example, if you're in the restaurant business, you're buying ingredients at a low price, right, and selling the food at a higher price. And the difference is your gross profit. And of course, you have to deduct your operating expenses like rental and salary to get your net profit, right? Now, in business, you can also sell something to your customer, collect the money up front, and then make the product, which costs you money, and deliver the product. So in other words, you could always sell first, sell high, and make low, deliver the product, okay? So the same thing goes in trading business. The only difference is that you're not selling and buying physical assets, right? You're selling and buying financial assets like stocks and ETFs and currencies, okay? Now, in the world of financial assets or stocks, for example, there are only three things that a stock can do, a stock price can do. It can either go up, it can go down, and it can go sideways, all right? So we're going to learn in this course how to determine the probability of the price direction. Now, there's no guarantee and you can't get it right all the time, so it's just a probability, but it's all we need to make consistent profits, right? So for example, if you determine that this stock, Home Depot, has the probability of the price going up over time in the short term, you make money by buying low and selling high, or buying high and selling higher, right? We call this going long on the stock, right? So when you hear the word going long, it doesn't mean that you're holding for the long term. It simply means you're buying at a lower price, you're selling at a higher price, and you're making the profit from the difference, okay? So for example, say the price was originally at $120 per share. So you believe that it has the probability of going up, okay? So what do? You buy at $120, okay? So when you buy, it's a debit, right? So it's debit $120 because you have to pay $120, right? Now, say the price goes up as you anticipate to $150, and you say, fine, I'm going to sell it to take my profit. So you sell it at $150. So when you sell it, it's a credit, all right? Money comes back of $150. So what's the difference? The difference is $30. That's your gross profit, like in the restaurant business, right? The difference between the ingredients and selling the food, okay? Now, of course, you have to deduct your rentals, your overheads. So in the trading business, the only overheads is, ta-da, commissions, right? So you have to use a stockbroker to enter and exit the markets. And a stockbroker will charge a commission. So you have to find the right stockbroker, because commissions can range anywhere from $1 to $10 per transaction. So usually the brokers I use are $1 to $3, which is a lot more manageable. Okay, so if you take $30 minus $3, right, that's a $27 net profit. So what if we determine that the probability is for the price of the asset to go down in value? The price is going to go down. So the way we make money is by going short, all right, or what people call short selling. So in this case, we sell high and we buy low, right? Just like a business where you sell to the customer the product, you collect the cash, and then you make the product at a lower cost, and you make the difference, right? So you do the same thing in the stock market. So for example, Twitter is at say $30, right? And you know or you think that the price is going to go down. So what you do is you click sell and you sell it at $30, right? Now some of you may be wondering, how do I sell something which I don't have, right? Well, in the financial world, when you sell something you don't have, it's called a short sell, or you're going short. So what happens is the broker will lend you the shares to sell, right? And this lending process is a split second, it's instantaneous, right? Now, not all shares can be borrowed to sell, but most of the shares that we trade will be shortable in that way, okay? So let me explain again. So you click sell, the broker lends you the shares, you borrow the shares and you sell it, and you get a credit of $30 per share, okay? Now, can you take this money and run? No, because you borrowed the shares to sell. So you have to return the shares, right? So how do you return the shares when you sold it? Well, you got to buy it back, right? So what you want to do is you want to buy it back at a lower price. So you wait for the price to come down to, say, $18. And what do? You go into the market and you buy it at $18. Okay, so that will cost you $18. But remember, you already have a credit of $30. You borrowed the shares, you sold it, you get a credit of $30. Now you buy it back for $18. Okay, so what's your net profit or your gross profit is $22 in profit. Okay, so of course the broker will not lend you the shares for free. There is a borrowing fee that you have to pay, which is about 2 to 3% a year. Now we're not going to borrow it for a year. We're going to only borrow it and sell it and buy it back within a few days, or very most a few months. So the cost of borrowing is quite negligible. Okay. Now you also have to deduct, that's right, commissions to the broker, right? Whenever you sell and buy. So $22 deducting your commissions and your borrowing fee, maybe you're left with $19. Okay, for example. So your net profit could be, for example, $19 per share. So if you had shorted 10 shares, you would have made $190. Right? If you had shorted 100 shares, you'd have made $1,900. Now, some of you may have some questions like, okay, if I borrow the shares and sell it, is there a time limit where I have to buy it back and return the shares? No, there isn't, right? By the way, I'm talking about the US markets here and most major markets, right? US, Singapore, and Hong Kong, there's no time limit. You could borrow and sell and buy it back 10 years later. But of course, you wouldn't do that because the longer you borrow the shares, the more interest you have to pay to the lender, who's the broker. Okay. Now, the other question people would have would be, must I have capital in my account in order to perform a short sale? Of course, you need to. To perform a short sale, you have to open what is known as a margin account. All right, margin account, and we'll talk about this more on the lesson under stockbrokers, which is lesson number 9. So you have to open a margin account. And usually what happens if you are selling short, say 100 shares, in this case, of $30. So you are selling short 3,000. Right? So in other words, you're borrowing $3,000 worth of shares and you're selling it for 3,000. Okay? Now, you have to put some collateral in case you end up losing money. Remember, in any trade, you could lose money because if you are selling at 30 and if it goes up to 32 or 33, you got to buy back at a higher price, you're losing money, right? So you have to put a collateral with the broker to ensure that if you lose money, you can make good on that loss, okay? So usually if you're selling short $3,000 worth of shares, you need at least 1,500 of capital in your account to begin the process, or rather 50% of the amount that you're shorting, right, which is 1,500. So that's how short selling works. So you can see that in the business of trading, we don't really care where the market goes, right? If the market goes up, we make money by going long, buying low and selling high. When the market goes down, we make money by going short, selling high and buying back low. And that is what makes the trading business recession proof. I mean, the whole market can collapse and we are still making money. All right. So there's no such thing as a good or bad market. All right. You make money regardless of the price direction, as long as you get the direction right. So how do you get it right? By studying technical analysis, by studying probability, which is what we're going to be learning in the lessons to come. So if you've always wanted to be an entrepreneur, to be in business for yourself, trading is one of the best businesses to be in for a couple of reasons. Number one, it's really flexible, all right? Now, if you start any other business like a boutique or a restaurant, you have to work for what? 8, 10, 12 hours a day. But in a trading business, you can make a very good income by working no more than 1 to 2 hours a day. And I'm going to show you the routine and the process in the lessons to come. Next, you can work from anywhere in the world, right? From your bedroom to lying on the beach, right? Or sitting in a cafe, right? I don't know about you, but I hate waking up early in the morning, and I hate, fighting the jam to work and fighting the jam back. When trading, you don't have to do that, right? Again, anywhere in the world, you could be trading while you're traveling, right, with your family. Next, no employees, no politics to worry about. You don't have to manage people, right? Hiring and firing. I don't like that, okay? Next, no rentals, right? You don't have to rent a shop to do it. All you got to do is to pay commissions to the broker, which is minimal rental to be in the trading business. Next, no competitors. Sure, there are many traders around. But what I love about this business is that, see, if I teach you how to trade and you make money, I don't make less money, all right? So it's not a competition, so-called, right? So when I teach you all my skills, you can make money, I can make money, we can all make money together. And those people who are losing money are the ones with no skills, with no business plan, all right? So that's the great thing about it. We can cooperate and make money together, okay? Next, no products or inventory. Unlike any other business, you don't have to buy and store inventory. Because again, we're trading financial assets. There's no physical assets, so-called. We're trading numbers, okay? Next, recession-proof, right? People are always concerned, right, about the next recession. Will I lose my job? What's going to happen? But again, in trading, we make money going long, going short. Right? We really don't care where the market's going, as long as we can read the trend of the market. Next, low startup capital. Nowadays, in most businesses, you need at least 50 grand, 100 grand, 200,000 to start a business, right? To pay the rentals, renovation, hire employees. Not in trading. In trading, you could start with as little as 2 to 3,000 US dollars, all right? To whatever, you can start with $1 million, right? So it's very flexible. Finally, it's one of the lowest risk businesses you can be in. See, many amateurs think that, hey, trading is risky. Sure, anything is risky if you do not know what you're doing. Climbing a mountain is risky. Driving a car is risky. Starting a restaurant is risky, right? If you don't know what you're doing. But if you know what you're doing, trading has got the lowest risk as a business. Why? See, if you start a restaurant or again a shop and it doesn't work out, how much do you lose? You lose everything. You lose 100% of what you sunk in, right? But in the trading business, when you trade, you only risk a small percentage of your capital on any trade, which I always recommend to start with 1% risk, right? So even if you get, for example, 5 losses in a row, or say even 10 losses in a row, that's 10 losses times 1%. The worst that can happen is you lose 10% of your capital temporarily, because eventually you will make it back if you continue trading with the right system that gives you a positive statistical expectancy in the market and edge. The other thing is this. In trading, you always want to start with a demo account, which means you don't put in real money, all right? The broker will give you, say, 100,000 of virtual cash. So you practice with that. And only when you can make money consistently with demo virtual money do you put real money in. It's kind of like a pilot, right? Before you actually fly the plane, you get in the simulator and make all the mistakes you can make, because you will make mistakes, right? You can crash 100 times, no one dies, right? Only when you get it right do you fly that plane. And you can do that in the trading business. In no other business can you do that. Can you realistically test your business model without risk? Right? You can't start a restaurant and say, you know what, I'm going to start a demo restaurant with demo customers and demo food, and if it works, I continue with real money. You can't do that, but you can do that with a trading business. Now, the good news is that anybody can be successful as a trader. You don't have to be a specific age or gender or background. I've seen people who are old, who are young, who are former housewives, former bankers, former medical doctors become very successful in the trading business. So what do you need? What you need is a hunger to succeed, a strong desire, a commitment to work really hard, okay? As well as a willingness to learn and master these skills, and the ability to really open your mind and to change your mindset. In this great book, Market Wizards, written by Jack Schwager, he interviewed some of the best traders in the world. And these guys are making phenomenal amounts of money, right? Turning a few $1,000s to millions of dollars, many of them from their home, right? And he interviewed them to find out what they all have in common. And he found that they all had three qualities that made them really successful. The first quality that they had was they all had a winning system or winning strategy with a positive statistical expectancy or an edge in the markets. What does it mean? It means that no strategy can win on every trade. But when your system has a positive statistical expectancy, it means that over a number of trades, you will always be profitable. Why? Because you will win more than you lose, although you can't win all the time, right? Your average wins are bigger than your average losses, and that is what leads to consistent profits. Now, bear in mind that although having a winning strategy and system is really important, it's critical, but it is only 10% of what makes a successful trader. Why is that so? Because what he found was that all these successful traders had a fantastic winning system, but their approach to the market, their strategy was completely different. For some of them, it was like night and day. So let me give you an example, right? So for example, in terms of instruments, it was very different. Some of them, they were trading stocks, right? Like for me, I'm primarily a stock trader. That's where I make most of my money. But some of them would be primarily trading currencies, right? Forex, right? Some of them be trading futures, some trading options, bonds, right? So back to the restaurant metaphor. If you want to start a restaurant, you can't ask, hey, what's the best restaurant that's going to make, good profits? Is it a Japanese restaurant, American style diner? Is it an Indian restaurant, Chinese restaurant? The answer is this: you can be very profitable in any kind of restaurant, whether Japanese or American. You just have to be really good in that style of cooking. Okay? So there's no best instrument. People always ask me, Adam, is it better to make money in stocks or Forex? And I said, there's no better instrument. You can make money in any instrument as long as you master that instrument. And every instrument has its pros and cons, has its own characteristics. So you have to find an instrument that so-called matches your personality in a way, right? And personally, for me, I find that stocks are a lot easier because it's easier to read the trends. The trends are more reliable. Whereas in currency trading, the trends are not as reliable. But the good thing is that currencies are 24-hour market. So there are more trading opportunities. Whereas the stock market is only open from 9:30 a.m. to 4 p.m. Now, futures, on the other hand, is also a 24-hour market if you trade futures, right? Problem with futures is that there's an expiry date. So you have to keep on, rolling over your futures contracts, closing the current month and opening a new month if you're holding for a certain period of time, all right? Some people make a lot of money on options, right? Personally, I don't really fancy options because options tend to work well for a non-directional method. When you're net seller of options, you use things like iron condors and credit spreads, okay? Options are not profitable when you use them for directional trading. That means when you buy a call thinking the price is going to go up, all right, or buying a put thinking the price is going to go down. Normally you will lose money when you are net buyer or seller of options, right? So that's why I found my own journey. So for the purpose of this course, we're going to focus primarily on stock trading, right? As well as using CFDs or contract for differences. I will also be launching a future program on currency trading as well. But for this one, the main focus again is on stock trading, right? The next thing is on time frames. If you study very successful traders, they all trade on different time frames. So it's all a matter of preference. There's no right or wrong, okay? Generally, there are 4 time frames you can trade in. Okay, the first one would be known as position trading, also known as long-term investing. So if you look at someone like Warren Buffett, his time frame is in years. When he buys a stock, he's going to hold it for 5, 10, 15, 20 years. He's taking a long-term position. So that's called position trading. And normally for position traders, they look at daily or weekly or monthly candles in reading the stock chart. Or they may not even read stock charts at all, right? They focus purely on the fundamental approach where they study the fundamentals of the company. They're not concerned with the daily fluctuations in the price, right? And the holding period again is months or years. So that's a long-term time frame, okay? So that's one style. It's a Warren Buffett style, okay? And then another style would be known as swing trading, which is one of my major styles. So swing trading is one where when we study the charts, we're looking at daily candles. Okay, and typically our holding period is in days, right? We buy and sell within 2, 5, 6, 7 days as a swing trader. Okay, typically you do anywhere from 10 to 20 trades a month. Okay, the next style would be day trading. All right, so day traders they buy and sell within 24 hours. Right, it could be within 5 hours, within an hour, half an hour. Okay, and they normally look at the minute candles and the hourly candles. Okay, so I'm a day trader as well, but I normally trade the first hour of the market open, and that's where I make most of my money. All right, I don't trade the rest of the day, not as profitable. Right, and then you also have got scalping. Scalpers, they buy and sell within minutes, sometimes even within seconds. Right, and that's right. So they look at a minute candles and sometimes even second candles. Okay, so once again, people may ask, hey, what's the best time frame? Daily candles or minute candles or hourly candles? And the answer is there's no right or wrong. Okay, there's no one style. There are many styles, and you can do well in any style as long as you focus on that style that suits your personality. So it's kind of like, let me use a sporting metaphor, right? Say ping pong is a game, or table tennis is a game where you have to move really fast, right? Golf is one where you take your time, look at the ball, take the right stance, take a swing, practice swing, right? So slow and steady, okay? And it takes someone like a Tiger Woods in his heyday when he did really well in golf, right? He's a champion golfer. And if you were to ask him to play ping pong or table tennis, would he do well? Maybe not, right? If you get a champion Chinese ping pong player and ask him to play golf, he may not play golf really well because it doesn't suit their temperament, okay? So if you're someone who likes to take it slow and easy, all right, you should be a long-term investor, right? A position trader. If you're someone who likes to move really fast, right, buy and sell really fast, and you're really good at calculating mental mathematics, then scalping is your thing, right? If you're kind of like in the middle, all right, I don't wait too long, but I don't want to watch the market every day, okay, then you'd be more of a swing trader, okay? So in this trading course, you're going to be learning a whole range of strategies. Now, I'm not going to cover position trading in this course. This course will be focused more on swing trading and day trading, with a bit of scalping as well. All right. Next thing is methods and styles. And again, different traders who are just as successful have very, very different styles. Some people are purely fundamentalists, right? So they make decisions based on studying the fundamentals of a company, right? The profit and loss statement, the balance sheet. Some study the macro trends like interest rates and GDP and blah, 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 whatever it is, right? And some traders focus on technical analysis, reading chart patterns, okay, candlesticks, support and resistance, trend lines, okay? And again, there's no right or wrong, okay? You have to find a style that suits you, all right? And my preference has always been technical analysis. I have to say this, when I first started at 18 years old, I've been trading for more than 24, 25 years, right? I first started as a fundamental investor, right? I was a position trader. I used to hold my shares for months and years. And when you have more of a long-term style, you focus more on fundamentals. You don't care about the short-term price trends. And I made pretty good money. In fact, I made my first million as a long-term investor. But then I saw other people were able to make a lot more money, a lot faster, using shorter time frames, okay, and using technical analysis. So I would say kind of like about 12 years ago, I shifted from fundamental analysis to now purely technical analysis, from position trading to now swing trading and day trading. all right? And it suits my personality, it suits my time, and I'm able to generate a lot more profits. So I'm going to be focusing mainly on that in this professional trading course. And again, there are some people, you talk to them and they're great traders and they say, you know what, I'm a trend follower. So what does that mean? That means to say they buy on the uptrend, they sell on a downtrend, right? That's called trend following or continuation trading. Now, on the other hand, there are also people who make a lot of money doing counter trend trading, right? They do the complete opposite, right? Where they buy on downtrends when it's really undervalued, when it's oversold, right? And they sell on uptrends when it's overbought, when it's too expensive. And they too can be really successful, right? So again, there's no one way. There are many ways. You just have to know for each way what is the key to master that strategy. And I'm just going to show you a few charts to illustrate my point a bit more, okay? So this, for example, is a trend following style where we follow the trend of the market. So in this case, you can see that the price is on a clear uptrend, all right? So I'm going to use this to draw, right? That's the price. You can see it's on an uptrend, like so, right? An uptrend is defined as, you know, higher highs and higher lows. You're going to learn this on the lesson on technical analysis, right? And you're also going to learn that on an uptrend, the price that you see, these candlestick patterns you see there, right? It's above the moving averages, which is this blue line, the green line, the red line. These are the moving averages. So when the price is above the moving averages, it's a clear uptrend, okay? So people who are following the trend will buy on the uptrend, and the best time to buy is when the price makes a temporary dip on the uptrend or retracement, okay? So we call this a impulse, retracement, buy, continue the trend, all right? So we call that a retracement or a dip on the uptrend. So you buy the dip on the uptrend, right? If in this case the trend is going down, it's a downtrend, you can see the price is below the moving averages, and the price is, you know, doing this, right? The price is making lower highs and lower lows, right? There's a downtrend, right? So on a downtrend, what do? You sell, you short, because you follow the trend, okay? And the best time to sell short is when the price makes a temporary retracement or rally to the moving average, right? So it goes up, you sell, profit as it comes down, okay? The other thing could be the price is in a consolidation, right? Going sideways, right? Hitting a resistance, a resistance, a resistance, right? So it's having a resistance, and the moment the price breaks out of that resistance, you buy on the breakout. We call this breakout trading, okay? Some people, they don't buy on the breakout, they wait for the breakout to retrace, come back to the previous resistance that has become support, and they buy as the trend continues. Right? Now, if you're a bit confused right now, don't worry. I'm going to cover all this in detail under technical analysis. I'm just giving you a little taste about the different styles of when to enter a trade. Right? So in this case, it's a trend following style. In this case, for example, this is a counter trend trading style, which we will learn as well. So in counter trend trading, you are buying against the trend. Okay? So in this case, you can see that the stock is on a downtrend, right? It's going down, up, down, right? It's on a downtrend, and we buy right when it's at the bottom of the downtrend. When it's oversold, we buy for this quick bounce up, all right? And we quickly exit over here before the trend continues down. That's called counter trend trading, okay? Or in this case, the trend's going up. It's going up, retraces, and goes up all the way to a high when it's overbought. Okay, when it's really expensive, you see a certain candlestick pattern, you say, okay, it's going to retrace, you do a short sell. Okay, you sell on the uptrend, and it comes down, you're making money, and you quickly buy it back to cover your short position before the trend continues. Right? So it's very different methods, very different strategies. Okay? So that makes up a winning system. So in this course, I'm going to show you a whole series of winning systems. Some of them are trend following, some of them are counter trend. Okay? But all the systems you're going to learn in this course have a very high positive statistical expectancy. In other words, they will always generate profits when you trade it consistently. Now, the other thing that makes up a trader's success is 30% of the equation. And it's the trader's ability to manage their money effectively or to manage their risk effectively. And we call that position sizing. So what do all great traders have in common? They know how to size the position of their trades. So they know mathematically exactly how many shares to buy, how many shares to sell short. Why? Because no matter how good your system is, you will not get winning trades all the time. And that is why you must have the discipline to risk only a small percentage of your capital. So that in the event that when you get it wrong, and you will at times, in the event that you get a drawdown or series of losses, it will not wipe you out. You're able to have enough to stay in the game, to continue to eventually make that money back and a whole lot more. All right? So you find that most amateurs fail in trading. Why? They blow up their accounts. They lose all their money. Why? Because they don't have a system for managing their money. All right? They don't calculate the number of shares to buy based on a specific formula. When they feel confident, they buy more. They don't feel confident, they buy less, right? And by doing that, you will not get consistent results. So position sizing really is a very important part of the system that you'll be learning to ensure that when you win more than when you lose, okay? So that makes up 40% of your success. The whopping 60%, the main contribution of a trader's success is what we call having the right psychology, okay? Or the right emotional discipline. So what is having the right psychology means? It means you must have the mindset to consistently execute the trading system and position sizing system consistently without deviation. All right, and to do that, you must have emotional discipline. Right, you must have that mindset of discipline, motivation, focus, on determination. Right. Now, why? Because if you don't have the ability to manage yourself, right, and you have emotions like fear, you may not take a trade when it comes because of a previous loss. Or you may have this thing called greed, where you overstay a trade and the profit turns to a loss, or you shift your target price too much, okay? Or you are impatient and you jump in when there's no clear signal to buy and sell. So all these things are what cause traders to not make money consistently. All right. So in this professional trading course, you're going to learn how to put in these three qualities within you, right? You're going to learn, once again, great winning systems with high statistical edges. You're going to learn how to manage your money with position sizing, and most importantly, you're going to learn how to develop the winning psychology of a professional trader. So let's get started.